What is going on in Japan? Since the beginning of 2021, the Japanese yen has lost around 40% of its value against the US dollar. And more recently, the Bank of Japan had to step in and intervene in the currency markets to avoid the yen from collapsing even more. So why is all of this happening and what effects will this have on Japan and on the West? Today we're going to find out. So, are you ready? Let's go. To answer our questions, we should first look back in time to see what has caused this entire situation. The problem all started with something that we are all familiar with in the West, which is asset price bubbles. The Japanese asset price bubble lasted from 1985 till 1991. And by 1991, commercial land prices rose 302.9% compared to 1985. In 1991, the land value in Japan was nearly $20 trillion, which was approximately 20% of world wealth and more than double the value of the world equity market. For example, the land beneath the Emperor's Palace was estimated to be worth as much as all land in California or Canada. Now, the reason for this speculative asset bubble to become so extremely large, that's a whole nother video, but one important cause was the Plaza Accord in 1985. And this is important because it will come back later on in the video. But essentially what it came down to was that Japan and some other Western countries at that time had enormous trade imbalances. So of course they wanted to reduce the trade imbalances. At that time Japan had enormous trade surpluses and the yen was also, just like right now, extremely weak. So what did they do? Well, they sold dollars and they bought Japanese yen. Now, because of this, the Japanese yen rose a lot and that had an enormous impact on their exports and therefore their economy shrank a lot. As a response to this, the central bank, so the Bank of Japan, decided to lower the interest rates, so in this case that's the discount rate, to boost the economy. But as we all know, just like in the West, lowering interest rates leads to speculation and it leads to asset price bubbles. Now, this definitely wasn't the only reason why the bubble grew so large. There were also many other reasons like financial liberalization, loan growth quotas, and of course monetary policy. But again, that's for a whole nother video. What's important for this video is, as we all know, the party cannot go on forever and eventually this bubble collapsed. So everything from stocks to real estate all collapsed in value. And the period that came after this is sometimes referred to as the last decade and sometimes even referred to as the last decades because the economic performance after the bubble popped was so extremely bad. But what does this whole story have to do with the question that we are trying to answer today? Now, as a response to this declining economy in the 90s, the government started spending a lot and virtually lowered interest rates to zero. That's something that we're quite familiar today as well. Now, when that did not work, the Central Bank of Japan started to do something that was very unfamiliar for the time. They started quantitative easing for the first time in central bank's history. So how did that work out? Well, according to this paper by Bowman et al. From 2015, the effect of QE on bank lending, so the effect of QE on sort of the real economy, between 2001 and 2006 was positive and significant, but it was likely very small. And this is in line with these two figures. So in the top graph you see GDP and core CPI. And during this whole period, during QE, from 2001 to 2006, GDP remained constant and so did CPI. Now when we go to figure 4, to the loans, we see that the growth in loans was also relatively flat up until sort of the end. So the effect on the real economy wasn't really there. And given the fact that they are still doing quantitative easing, in fact, they even said that they are doing QE infinity, right? They are buying an unlimited amount of government bonds and they're also doing yield curve control, which I will explain later on in the video. I don't think it's really working. So let's first go to the first article over here, which is from Zero Hedge. Did the Bank of Japan just blow $50 billion for nothing? And as we all know, the Bank of Japan has intervened. And this spike in this first figure and another spike over here Yeah, this is not a normal market participant. This is the Bank of Japan intervening and buying Japanese yen. But as we can see, every time they have done this, the Japanese yen has just fallen again, which means that, yeah, it sort of has been for nothing. And the article states that the Bank of Japan has put in 50 billion US dollars in these attempts to sort of prop up the yen, and eventually nothing really came of it. And before we go into the second article, which has to do with yield curve control, let me explain what yield curve control is. So yield curve control is essentially pegging the yield curve to a certain rate. So in this case, in Japan's case, it is 25 basis points or 0.25%. And every time yields on 10-year Japanese government bonds go above this line, so above the 0.25%, they buy these bonds so that the yield decreases to that maximum of 0.25%. But what is now going on, and this is also what this article by Zero Hedge shows, is that it's not really working. It's not working. And why is it not working? Because the yield on that 10-year Japanese government bond has gone multiple times above the barrier of 0.25%. So they're buying, but it's not working. So on the one hand, you have the Bank of Japan, which is doing unlimited QE. In fact, the Bank of Japan now owns more than half of all government bonds. And according to, again, this article by Zero Hedge, they have been buying so many bonds that some of these bonds will simply stop trading and the entire market will be sort of nationalized and it will just cease to exist. And then on the other hand of the spectrum, you have the Federal Reserve. Federal Reserve is tightening monetary policy, they're raising interest rates, they're doing quantitative tightening, right, and they're selling bonds. Now, this undoubtedly has had a large effect on the exchange rate between the two countries. And this is also what the mainstream media is telling us, right, if you look this up online. But it's not the entire story. In fact, maybe it's not even true. Because when you look at interest rate differentials between the US and Japan over the period I've graphed over here, we see that interest rate differentials have been all over the place, while the exchange rate has been relatively stable up until January of 2021. And in addition, the yen already started losing value against the dollar even before the Fed started raising interest rates. Now, that could be because the Fed was already signaling that they were going to raise rates and that was then priced in, but what else happened in January of 2021? Well, a possible explanation could be the supply shock. Since January of 2021, import prices have skyrocketed while volume has remained flat or even decreased. So it looks like Japan has a really strong and robust economy when you simply look at how much they import in total. But if you look closer, that's not the case at all. And this is also what you can see in this graph over here. In fact, I would argue that Japan is heading for a recession as well if it's not already in one. I mean, sure, the dollar is the reserve currency after all, and everyone needs dollars to settle transactions. And that's an important reason why these import prices have gone up so much, but it's also supply shock related. The fact that certain goods and services were unable to go from one place to another, or at least not as quick, and you had all these lockdowns and all these policies, those are important factors why import prices are so high. So now that we know that the Japanese yen is falling, what implications does this have for Japan and presumably the rest of the world? Well, because of the depreciation, the Japanese need to pay much more yen for the same amount of dollars. And this can be seen in their trade deficit, which has absolutely exploded. Now, this is actually quite ironic because in theory, what you would expect in also basic economics 101 is that a weak currency means that you can export a lot, right? You have a weak currency, so foreigners can import your stuff sort of very cheaply, which means that you should have a trade surplus. But in this case, the dollar is so strong that it is outweighing this entire scenario, and therefore their trade deficit has absolutely ballooned. And because dollars are now extremely expensive and presumably too expensive to facilitate trade, to the point where some would even argue there's a global dollar shortage, the Bank of Japan is now forced to drain their dollar reserves, which they have accumulated over time. So at the moment, the Bank of Japan can simply borrow dollars and sell them to the Japanese market, but what they're mainly doing is they're depleting their FX reserves. So they have a lot of US treasuries on their balance sheet. They're selling those treasuries, converting them for cash and then buying Japanese yen. But as this article states, this cannot go on forever and something needs to change, because at this rate its reserves would be drawn down over the course of about 20 months. I believe that if the dollar stays strong against the Japanese yen, that it will definitely hurt Japanese businesses and the economy. But there might also be some businesses that will not really feel the impact at all. Now, if you import commodities from abroad and therefore you need to buy them in dollars and sell to the domestic market in Japan, and you receive your revenues in Japanese yen, these are the businesses that will suffer the most. Now, most of the larger Japanese companies like Toyota, like Honda or like Sony, these are companies that have plants abroad, or maybe they don't have plants abroad, but they produce in Japan and then they sell their products abroad. These companies will likely be fine, but overall I think a rising dollar will definitely have a severe impact on Japanese businesses and the Japanese economy. Now, moving on to the effect that this could have on the West, it will first of all have an effect on the US in terms of rising bond yields, right? Because the Bank of Japan is intervening, they are selling these US treasuries, meaning the price of these treasuries go down and therefore yields go up. Now, the second thing might be that the US or other Western countries will finally realize that, okay, if Japan is struggling, then we will also have a shortage in products, right? Because businesses in Japan are failing, their input costs are very high, profit margins are getting squeezed, so production will be less. And that means that there could be a shortage in countries like the US, countries like Europe, and therefore inflation could again go up. And of course, I'm not only talking about Japan, right? I'm also talking more broadly here. The dollar in general has risen against every other major currency. So it's not only Japan that could cause this. But you might be wondering, what is now the solution? Well, the solution definitely won't come from Japan in the short term. The Bank of Japan governor, Haruhiko Kuroda, yes, he will likely stay in office until April of 2023. And given that his entire history, his entire legacy is based on QE and 0% interest rates, it's very unlikely that he will deviate from this course. And given the fact that the Federal Reserve is still very hawkish, still raising interest rates, still doing QT, right, quantitative tightening, it's very unlikely that something is going to change in the short term. So this is pretty straightforward, but there's also some good news. His follow-up in April of 2023, not really sure yet who that will be, but he might go a different path. And this different path needs to be the solution, because QE needs to stop the 0% interest rates, right, the yield curve control at 0.25%. All this nonsense needs to stop, and they actually need to do the opposite. And on the other hand, if you want to decrease the dollar against the yen, something needs to happen in the US probably as well, right? They need to stop with QE, or they need to stop with quantitative tightening, so QT, and they need to lower interest rates again. So probably a combination of both. Another solution, and this is why I referred in the beginning to this point, is that Plaza Accord. We might get another Plaza Accord 2.0 if the Federal Reserve doesn't stop with raising interest rates and their monetary policy. Now, this is something that George Gammon mentioned, and I will leave, if I can still find the video, I will leave a link to it in the description. Now, this Plaza Accord 2.0 would mean that the yen would rise in value and the dollar would fall. And he even mentioned in his video that the market could front run this because, hey, if the central banks announce, or if the governments announce that they are going to sell dollars and buy Japanese yen, then the dollar might even fall just based on the announcement without them even doing it, right? The market could front run, let's say in this case, the Federal Reserve. And therefore they don't have to do anything, and you get sort of this negative spiral, and the dollar collapses even more, especially if they then actually do it, right? So you get this sort of self-fulfilling prophecy of a currency that can only go lower. Now I'm going to end the video here. Let me know what you think about the topics I discussed in this video. So what do you think about quantitative easing? What do you think about yield curve control? What do you think about the falling yen? Please let me know in the comments. Don't forget to like or subscribe. And oh, by the way, I've made a Twitter account. I will leave a link to it in the description. You can follow me there as well. I'm quite active on there. But for now, that's it. Thank you for listening and have a nice rest of your day. Bye bye.